Here is the conclusion first. BP is trapped, not by oil prices, not by regulators, not even by the energy transition. It is trapped by the story it told investors about itself for the last 5 years, and now it cannot get out without someone taking a serious loss. That is the real story behind the 125 mentions BP generated in energy coverage this week. This is not routine noise. This is the market sensing that a decision point is coming and positioning accordingly. Let us start with what is visible on the surface. BP shares have rallied approximately 30% since January. That is a substantial move for a major integrated oil company, and it has naturally attracted both excitement and skepticism. The excitement is straightforward. Oil prices climbed sharply, Middle East tensions kept a floor under crude, and investors who had written off the old energy majors as dinosaurs suddenly remembered that dinosaurs were in fact very large and very powerful. The skepticism is equally understandable. The shares have already pulled back roughly 7% from their recent peak. Earnings fell sharply in the most recent reporting period, down more than 100% year-on-year, dragging BP from profit into loss. The forward price-to-earnings ratio sits around 13 times. Not expensive, but no longer the deep value entry point that made the stock compelling a year ago. The dividend yield of approximately 4.4% remains one of the more attractive income propositions in the FTSE 100, but with a debt-to-equity ratio around 1.37, the balance sheet leaves limited room for error. So the surface story is BP rallied hard, it got a little expensive, earnings are messy, and now we wait. That is the consensus. And if that were the whole story, we would not be making this video. Here is what most coverage is missing. The activist investor pressure on BP is not simply a demand to drill more wells and pay bigger dividends. It is a demand to abandon a strategic identity that BP's own management spent years and considerable shareholder capital constructing. BP, under previous leadership, made an explicit, public, and heavily marketed commitment to become an energy transition company, not just an oil company hedging its bets, but a genuine pivot toward renewables, low-carbon energy, and a reduced hydrocarbon footprint. That was the brand. That was the investor thesis for an entirely different category of shareholder. Now, with oil prices elevated and green energy investment returns disappointing across the sector, activist investors are pushing BP to reverse course. And here is the part that does not get discussed enough. You cannot reverse that kind of strategic commitment quietly. If BP formally abandons its green energy pivot, it loses one set of investors, the ESG-oriented institutions that bought the transition story. If it refuses to reverse course and sticks with the greener path, it risks losing a different set, the value and income investors who want maximum cash extraction from the hydrocarbon base while prices are favorable. BP is currently trying to please both, and the market is starting to penalize it for the ambiguity. Now consider BP's investment in Egypt. The country has launched a 5-year oil and gas exploration program targeting approximately 480 new exploratory wells, with total investment around $5.7 billion and 101 wells scheduled for 2026 alone. BP is a central participant in this program. Think carefully about what that means in context. This is a long-duration, capital-intensive commitment to hydrocarbon extraction, exactly the kind of investment that makes sense if you believe oil demand will remain robust for decades, and exactly the kind of investment that becomes a liability if you believe the energy transition accelerates faster than expected. BP is making a multi-year bet on traditional hydrocarbons, at the same moment it is under pressure to either double down on or walk away from its green energy commitments. These two things are happening simultaneously. The Egypt program is not incidental context. It is the clearest evidence that BP's strategic review is not abstract. Capital is already being allocated in ways that will be very difficult to reverse.
This is the reversal point, the thing most people watching BP are not weighing correctly. The question is not whether BP should pivot back to oil. The deeper question is whether BP has already pivoted back to oil in practice, while still maintaining the language of energy transition in its public communications. If that gap between stated strategy and actual capital allocation continues to widen, the company faces a credibility problem that goes beyond any single quarter's earnings. Activist investors are not wrong to push for clarity. The damage is not in choosing one path or the other. The damage is in refusing to choose. So where does this go from here? Let us walk through the two most plausible scenarios, because this is genuinely a fork in the road, and the outcomes are structurally different. In the first scenario, BP formally acknowledges the strategic shift. Management announces a clear reduction in green energy capital allocation, refocuses the investment case on hydrocarbon production and cash generation, and positions the company explicitly as a high-yield energy stock for income investors. If oil prices remain at current levels or climb further, this path leads to strong free cash flow, potential dividend growth, and a re-rating toward the more generous valuations that pure-play oil producers sometimes command. The Egypt program becomes a centerpiece of the growth narrative. Activist pressure eases, the stock likely performs well in an environment of sustained energy demand. The risk in this scenario is the long tail. If the energy transition accelerates faster than expected over the next decade, BP will have made a significant capital commitment to assets that could face stranded asset risk, and the ESG-oriented institutional investors it lost will not come back quickly. In the second scenario, BP holds the middle ground. Management resists full capitulation to activist demands, maintains some level of green energy investment alongside hydrocarbon expansion, and continues to position itself as a diversified energy company bridging the transition. This scenario preserves optionality, and optionality has real value in an uncertain energy landscape. But it also means continued strategic ambiguity, which markets tend to discount. In this path, BP likely trades at a persistent valuation discount to both pure-play oil majors and genuine energy transition companies, because it fits neither category cleanly. Recovery in this scenario depends on execution. BP would need to demonstrate that its hybrid model actually generates superior risk-adjusted returns, which is a harder case to make than it sounds. The convergence point to watch is the upcoming strategic review announcement. That is the moment when the ambiguity either resolves or deepens. If BP's leadership delivers a clear, credible commitment to one direction or the other, the market will likely respond with a decisive move. If the announcement is hedged and non-committal, expect the discount to persist and activist pressure to intensify. One final observation. The return on equity figure for BP currently sits at barely above zero, approximately 0.12%. That is not a number that reflects a company firing on all cylinders. It reflects a company in transition, absorbing write-downs, managing a complex capital structure, and trying to maintain a dividend yield that its current earnings barely support. That number is not permanent. Companies at genuine strategic crossroads often look worse precisely at the moment before they clarify their direction. The question for investors is whether the clarity, when it comes, will be the kind that re-rates the stock upward, or the kind that reveals the cost of years of strategic indecision. BP is not a broken company. It is an identity crisis company. And in markets, identity crises can resolve very quickly, in either direction.